entrepreneur, financial historian, and an Austrian school economist. Jason co-founded the startup investor education and financial education company Wall Street for Main Street, and I am very happy to have him back on the X22 Report Spotlight. Jason, welcome back to the Spotlight.
Glad to be back, Dave, and Happy New Year, because we haven't spoken since the calendar turned over to 2018.
That's true. Happy New Year to you. And hey, let's start off with what is going on this year. I mean, we see the stock market over 26,000 points. Yes, it came down a little bit. S&P 500 surging, and we know that the central banks right now, they're reducing their balance sheets. They're unwinding. At the same time, they are raising rates. And when you look at the total economy and you look at the central banks and what they're doing, how is this going to play out?
Well, first of all, the central banks are claiming they're going to unwind, but I'll explain that for a second. I do not think that the central banks have a viable, a real credible exit strategy. So maybe they can stop the liquidity injections for 3 months or 6 months, maybe even 9 months. God forbid, maybe even 12 months. Although I would prefer bankruptcies and no liquidity injections at all. But, I really think that they are going to at least experiment with taking the punch bowl away for a little while or reducing the amount that they've done. But let's put things in perspective about 2017, first of all. So you mentioned the stock market. The stock market's gone parabolic. It's just an insane growth rate. In my humble opinion, I don't think the real economy justifies this. What the Federal Reserve has actually benefited from, and they haven't done nearly as much QE as the Bank of Japan in 2017, the European Central Bank in 2017, and yet the capital markets in the United States were the prime beneficiaries of this. An enormous amount of money. I just interviewed Brent Johnson for my channel last week, and he talks about this, and he uses the milkshake analogy with the straw. So the Fed didn't have to do an enormous amount of QE in 2017, and yet they benefited from all these other countries, all these other central banks doing enormous liquidity programs, and that capital just flowed in. And in 2017, the global central banks, the Bank of Japan, the European Central Bank, the Bank of England, and the Federal Reserve combined put in over $3 trillion that they have publicly stated. This is not counting the central bank to central bank currency swaps, which they don't count on their balance sheet. There is no independent audits. We don't know that real number. So they have publicly stated that they put in they've expanded their balance sheets by over $3 trillion. A lot of that money went into real estate, bonds, and stocks. And so we've had just crazy asset prices that become more and more divorced from reality. The mainstream person, the average guy on Main Street's waking up now that the wealth disparity, the wealth gap is growing, while, the people in Davos just basically act like there's no big deal and they can continue on with their globalism plan. They're going to use the blockchain for nefarious purposes. But China, the People's Bank of China, Dave, in 2017, I really think your listeners need to understand this, because there's a lot of people out there that are libertarian, that are in the gold community, that are Austrian school economists that believe in that stuff, and they are defending China. And China has put more liquidity in 2017 than all those other central banks combined into their asset markets, into their banking system, and it's gone all over the place. So China is basically, the last 10 years, China has created an enormous credit bubble. And right now, China is in the happy part of this credit bubble, the boom phase. And if you believe some of the reports on the ground, the real GDP in China, and I don't like GDP, I don't think it's an accurate statistic, but these Keynesian central planners and all these different countries believe in it, and they use it, to finagle bond markets with debt to GDP ratios. But supposedly, Dave, because of this happy boom credit bubble phase in China, the real GDP in China hit 11% annualized last year in 2017, 11%, just an insane number. And so now China, in addition to all these other central banks that have gone crazy, injecting artificially cheap money and credit into bond markets, into stock markets, the Japanese central bank owns an enormous amount of the Japanese exchange-traded fund market. That's why the Japanese stock market has had a rally, not necessarily because the Japanese saver and investor has all of a sudden started buying stocks, but the Chinese have, on the People's Bank of China's balance sheet, they have almost $40 trillion now. And their state-owned enterprises, that's their internal credit bubble. That's their publicly stated. They have 220 trillion RMB. You convert that to US dollars. That's almost 40 trillion American dollars on their balance sheet for a credit bubble. And so, they have an external debt problem too, with their state-owned enterprises of 1.7 trillion in dollars Their trade reserves that they've accumulated is only about 3 trillion, to put that in perspective. So at some point, China could be the new largest global economic landmine. And yes, China's trying to do the petro yuan. I don't think China wants a gold standard or gold-backed currency, because in the next couple of years, I don't know if this is going to happen in 6 months or 12 months, but I will say, in the next couple of years, we've had hedge fund managers like Kyle Bass who've looked at these numbers like me, and they've mistimed this. They've been wrong for 2 years. But in the next couple of years, they cannot fully delay this. As the great Austrian school economist Ludwig von Mises says, at some point to deal with their credit bubble, China will have to do another massive currency devaluation. They will have to do bank bailouts. They will have to do bailouts maybe of state-owned enterprises. And they may even have to drastically resort to rules changes and maybe even wiping out shareholders in certain types of companies that have exposure to this. So there are some good things about the Chinese economy, but I think 2017, Dave, was defined as the year that the central banks just went crazy. It wasn't the Federal Reserve who was doing most of it, although the United States economy was actually benefiting from a lot of these massive trillions of dollars in liquidity injections. To put things in perspective, again, the Swiss central bank, which basically created money out of thin air, running a euro peg to try to keep the Swiss franc from rapidly appreciating too much. The Swiss central bank last year in 2017 made more money in trading profits than Apple, JP Morgan, and Berkshire Hathaway. The Swiss central bank made $55 billion in trading profits last year. These are not free markets. These are central bank coordinated markets where maybe there's occasionally currency wars, but there's a lot of intervention and manipulation and coordination going on. And there's nothing fair about this. So if you're the guy in the street, you're regular Main Street Joe, and you don't have a lot of access to capital like these hedge funds or these investment banks, you haven't benefited. Maybe if you have some money in your 401k, maybe your house has gone up. Hopefully you're not borrowing too much against that. Hopefully you're not taking out money on credit cards that you can't afford to pay back for chasing higher cryptocurrencies. But like I said, this has created a larger and larger wealth disparity, a larger and larger wealth gap. And you cannot blame capitalism for this. You really can't, because they're not allowing bankruptcies. They're not allowing failures of companies. You cannot have it's not capitalism if you're not allowing bankruptcies and failures. OK, but capitalism is going to get blamed for all this, along with President Trump, probably, when at some point, probably in a couple of years, because from a historical perspective, Dave, I really think this is more like 1927 rather than we're going to immediately have a stock market crash like 1929 per se. I don't see in the next couple of months necessarily, because a lot of people have been calling this for a while, that we're guaranteed to have a stock market crash in the next couple of months. One of the best investors that's still alive, Jeremy Grantham, he's actually predicting a 30% melt up, which the Austrians would call crack up boom. Martin Armstrong has alluded to this as well in the past. He's actually predicting a 30% rise in the S&P 500 with no fundamental justification for that rise, just incoming capital increases based on momentum, more and more speculative capital coming into the stock market for whatever reason, not for fundamental reasons. There's a lot of retail money also not for fundamental reasons that's coming in and buying up these passive ETFs, whether it's the new FANGs ETF, chasing those things higher. And so there's just tremendous distortions, and it's the central banks to blame. And I think, Dave, at this point, central banks have distorted things so goddamn much that in the next 3 to 5 years, there's very high probabilities that we may have Dow 40,000. We may have a huge stock market crash similar to 2008 or worse, 50% cut off the top in assets. We may have both of those things in the next 3 to 5 years, pretty high probability. The question is, what order will they be in? And then how central banks will react. And so it's just incredible, all the damage that central banks have done. And we have, these central bankers like Janet Yellen and Mario Draghi and all the others go on pretending how good the economy is, how good the Trump tax cuts will be, how they can magically raise interest rates and, reduce their balance sheet. The Federal Reserve, Dave, has really only reduced their balance sheet, I believe, around $11 billion when they claimed they were going to reduce it by a lot more than that. So there really hasn't been any balance sheet reductions yet. There hasn't been any major ones. And the Bank of Japan, Dave, was supposed to have started reducing their balance sheet too. And last year, the Bank of Japan and the European Central Bank did so much liquidity injections that their publicly stated balance sheets were larger than the Federal Reserve's. Well, the bond yields in Japan, Dave, recently started to creep higher. And because Japan has so much debt, they cannot afford to pay higher interest rates. So Japan was supposed to have an exit strategy, but the bond yields just spiked this week. And Japan's back to trying to manipulate the bond market, back to the liquidity injections, doing those to buy up bonds, Japanese government bonds, that they said they were going to stop buying. So where is the viable exit strategy? On top of all this, Dave, and I'm not an expert at this, is this euro dollar market that has exploded. And so I encourage all of your listeners to go to the Macro Voices podcast, and there's hedge fund manager Jeffrey Snyder on there. It's a 4-part special. I actually spent over 4 hours listening to this. And supposedly there's a lot of hedge fund managers and financial professionals that listened to him in past interviews speak and thought he was a nut job. But he lays out all the different evidence for how this euro dollar market, which is offshore US dollars, how investment banks have basically, without much regulation, with off-balance sheet derivatives trades and all these other financially gobbledygook instruments, financial engineering, including repos and other stuff, they figured out how to use enormous amounts of leverage on treasuries and US dollars. And basically, they've created a separate central bank that's not backed by a government, that's not like the Bank of International Settlements. And hedge fund manager Jeffrey Snyder says that there's around $15 trillion in extra liquidity from this euro dollar market that investment bank to investment bank has opened up. So off balance sheet without regulation. And he's been claiming that for decades now, the Fed realizes this and can't control it. No central banker can. And these all this liquidity, you have to follow where it goes. And this helps leads to additional bubbles. So on top of basically, Dave, when you add up all the numbers, and the numbers are staggering, there's what's the right word? Okay, there's compelling evidence from Catherine Austin Fitts and the PhD economist that they have collected about the Pentagon potentially, with the help of the Federal Reserve and Wall Street Bank, stealing, creating out of thin air $21 trillion. You add that number. You add the Chinese credit bubble. That's maybe almost 40 trillion right now. You add that euro dollar market. You add the tens of trillions, maybe 30 to 40 trillion that central banks have created since the 2008 financial crisis. There is potentially at least 60 or 70 trillion dollars in liquidity going in and out of the system at any one point, going God knows where, causing God knows what. And so central banks claiming that they have a viable exit strategy for all this, to me, based on my research, interviewing a lot of very sophisticated hedge fund managers, financial professionals, a lot of the guests you have on, that they have a viable exit strategy is total horseshit.
Don't you think, let's take number one, don't you think the whole illusionary economy, the illusionary stock market, this was done on purpose? This was to create the illusion that everything is great. And this is the reason why they can't stop doing it. I mean, they have to continue. There's no way they can just cut it all off, because what happens if they cut it all off? They could take so this is my argument, what I said at the very beginning, why they can temporarily maybe take a break, maybe allow a tiny little correction. The problem is that they think that they can allow a small correction in the stocks and it won't accelerate and feed on itself. So we really don't know all the leverage in the system. We really don't know what could happen if there's margin calls on an investment bank. We don't know if the other major thing, Dave, that I want to add here, and I mentioned this in past interviews, is this leverage short volatility trade. So in my humble opinion, I think there's another AIG out there. I think there's a stupid either insurance company or reinsurance company or an investment bank that has been selling these naked short straddles like AIG did and collecting premium, betting that the stock markets won't crash. And so I think that's out there as well. Now, will this happen in 6 months? Probably not. But maybe in the next couple of years, like I said, this may happen. We may go to Dow 40,000 before we crash. Jeremy Grantham and other people think that. So, but that would be similar to the 1929 scenario, where prior to the 1929 crash, for a couple of years, the U.S. was the best economy and tons of capital from all over the world flowed into the United States. There was record amount of stock margin debt back then. We're seeing a lot of similarities between then and now. There's record amounts of margin debt now out, over $800 billion. If you looked at a chart from the margin debt outstanding, that chart is parabolic too, in coordination with the Dow. And the other one is the CEO of TD Ameritrade, who has recently said that he's never seen so little cash in his customers' accounts.
So this is a euphoric phase. We can go higher than this. I'm not predicting an immediate crash. I've said on record that I think in the next 2 or 3 years this can happen, but it's not sustainable, like I said, for the real economy to continue. The other thing is with the Trump tax cuts is we're starting to see a weaker dollar, which Trump and Mnuchin really want. They can go on TV and say they want a stronger dollar, but Trump is basically running a really large version of supply side economics. With the problem is with his tax cuts, obviously I love tax cuts, but there was no real cut in government spending. Trump wants to actually increase military spending. He wants to increase infrastructure spending, although the government is supposedly not going to be. He said State of the Union that his infrastructure bill is going to be for $1.5 trillion, but he claims that the government's not going to fund all that. We'll have to see what happens with that. I think he's going to be able to get a lot more infrastructure projects done faster than Obama. That could be and then we're also starting to see for some people some slight wage increases. So people are getting a little bit more money in their pocket. That could potentially be an increase in the velocity of money, because we've had all this monetary inflation, as the Austrians would say. Basically, since 2008, central bankers have doused everything in gasoline, and there hasn't been the match. And the match is the velocity of money. That would be the hardcore stagflation, the potential runaway inflation that central bankers fear. We haven't had that spark or the match to light all the gasoline, the monetary inflation with artificial money and credit yet. But we might get that soon. And we'll have to see what happens with the dollar. I don't know if you saw recently, but Mario Draghi has been claiming that the U.S. already violated a verbal or written agreement that the Federal Reserve and the Treasury had with the ECB. And that was that they wouldn't devalue the dollar like this. They wouldn't allow for a weaker dollar. So it's very interesting. I was under the assumption, Dave, that the Federal Reserve, the Bank of Japan, the European Central Bank, and the Bank of England were all on friendly terms and coordinating this with each other. But this may be the break where the Federal Reserve, with Trump in, with Mnuchin in, has a different view of how they want to do things than previous regimes. So we may see breakout now discord between the European Central Bank, Europe, and the U.S., whereas for at least the last Obama administration, there seemed to be coordination there with monetary policy, with who's devaluing, who's doing QE, et cetera.
Let me just go back for a sec. You're saying that the central bankers, they might want some type of correction. Are you talking about like a small little correction and then continue to have the markets go up from there, just to show everyone like, oh, look, it corrected by like 10% or 5%, and then boom, we go up again?
Yeah. In a perfect world for central bankers, they could get away with that. So they would take maybe 6 months off from these liquidity programs, either stop doing them or reduce them drastically, and then allow like a 3 to 5% correction. Because look, like I said, the stock market's parabolic. It has not had, I believe, a 3% correction in over 140 days. It has not had a 5% correction in over a year. And so these things are not normal. Even people who don't study economics that much, a lot of traders, a lot of mainstream Wall Street people are noticing that this is not normal. So yeah, in a perfect world for central bankers, they would be able to either drastically reduce the amount, allow a correction, and then say, look, there was some corrections there, and then maybe they would. I think they want to wait and see what happens if there is a correction. The other thing is President Trump, and I've said this before, President Trump has set himself up by taking credit for this stock market rise. President Trump is going to get the blame when it does fall. So I don't know if the stock market's going to crash anytime soon, but almost definitely there's going to be a crash in the next couple years, probably less than 3 years. The difficult part of this is timing when it's going to happen and where it's going to start. And so you could interview 1,000 different hedge fund managers, 1,000 different economic experts, and probably get totally different answers on when it's going to happen and where it's going to start. But pretty much everyone's in agreement that, things are not how they should be right now with all this intervention.
So let me ask you this now. You mentioned Mnuchin, you mentioned Trump. Mnuchin came out and he said that he wanted a weaker dollar. Trump quickly said, no, we still have a strong dollar policy. Was this done on purpose to actually maybe break apart the central bank system, to shut the system down? Even though they have this written agreement, I mean, think about this for a sec. Trump has Andrew Jackson hanging in his office. Andrew Jackson got rid of the central bank. Do you think this might be a plan to shut it all down?
No, I don't think Trump is playing 4D chess that way. 6 months ago in 2017, Trump said he wanted a weaker dollar. So, I mean, he's flip-flopping on these things. He pays attention. He flip-flops on these things. Next week or the week after, he could change his mind. That's just the type of new normal that we're in right now. So I don't think Trump wants to use debt. He wants to use debt like Ronald Reagan used debt, but he doesn't realize that we're very late in an economic expansion in the United States. We're towards the end of a credit cycle. There's subprime auto loan bubbles. There's student loan bubbles. There's a shale oil bubble. There's tons of credit bubbles in the United States and in the global economy. I don't know if he realizes how late we are in the stages of these credit bubbles. So Trump has used debt to get rich as a real estate investor. A lot of these really high leverage real estate investors, they normally go bankrupt at least once because they're using so much debt. So, but the banks are willing to trust them again and start giving them money. And so that's why Trump, during the campaign, he said he's the king of debt, because he knows how to use debt with leverage to make cash flow and build properties out. And I think Trump wants to borrow more. So, we're going to see, maybe the Fed tries 3 interest rate increases this year. We'll have to see what happens. They announced they're not doing it, but that's probably because Yellen just wants to get the hell out of there and start making her 6 to 7 figure speaking fees, and then her pensions are kicking in, and then she's going to get either another academic job making more money, or a consulting gig, or speaking fees like Ben Bernanke and out in Greenspan and stuff. But I don't think that Trump really wants to break up the central banks, because he needs them. He needs the leverage. He needs that artificially cheap debt. And all the people that are advising him he's still getting advice from people who believe in mercantilism, who want a weaker currency. I mean, he's getting pretty much the same play. The one thing most people do not understand about supply side economics is it's really not that much different than Keynesian economics. Okay. So they're both central planning. Keynesians are just stimulating aggregate demand. And supply side economics is borrowing like crazy. The Dick Cheney deficits don't matter. It's still enormous central planning economics. They're just trying to stimulate supply. So they're doing it with tax cut. They're not cutting government spending, like I said. So the debt, in the long term, probably if President Trump gets reelected and gets a second term, you're going to see the debt explode. Now, maybe real GDP will improve in the United States, and Trump will talk about the stock market doing well. The GDP he'll claim is doing well. By the way, the GDP has been revised down a lot. So all of his 4% GDP numbers, not counting a real inflation rate, they're always revised down afterwards. But he's going to talk about the headline number that comes out. He's going to tout that as great. But you may see also, once we basically hit a point where pretty much no matter what's going to happen, what type of monetary and fiscal policy, the debt's still going to grow, because the size of government's not being cut. There's not active policy being done to try to drastically reduce the size of government. Okay. In fact, like I said, Trump wants to expand it. So the new normal is Trump's going to try to tout these headline growth numbers. Yes, it's good. People are going to get tax cuts. Some people are going to get more than others. Hopefully that will bring some jobs back. But, he inherited such a large mess that the policies he's trying to do long term, they're not going to make enormous improvements, because there's going to be more inflation. Even though people's income taxes are going to be temporarily cut, there's going to be taxes elsewhere, maybe state and local tax, that increase elsewhere to make up the difference.
Now, you also mentioned something about a separate central bank that's not part of the Bank of International Settlement or the Fed. What are you talking about when you said there's a separate central bank?
Okay, so the euro-dollar market, it started off really, really tiny. I would encourage, I'm not an expert at this, but I would encourage your listeners to go to the Macro Voices podcast and listen to the Eurodollar University and hedge fund manager Jeffrey Snyder talk about this. And so basically the Eurodollar market started in the 50s and 60s, and it was initially a small amount of money for larger investment banks and other corporations to borrow US dollars offshore to do their trade, to settle their trading. Because remember, the dollar was a world reserve currency, and to go from multiple currencies, say from Japan to Sweden transactions, it was easier normally to do dollars first. And so that market initially was a lot smaller. And then in the 70s, Milton Friedman supposedly wrote an article about this. In the 70s, that market, the euro-dollar market, which was offshore dollars and treasuries, the banks had created in the 1970s another $30 billion in extra money and credit out of thin air. And so back then, $30 billion was a pretty good amount of money that was not backed by gold, that was used for additional liquidity and speculative bubbles and stuff. Well, in the last couple decades, Dave, this market, this euro-dollar market, has exploded in size through a bunch of financial engineering tools like repos. And even now, Dave, and I was shocked to hear this, my research, my source who brought me the information from the IMF meeting in 2014, what we found out from the one-time Ron Paul audit of the Federal Reserve was on central bank to central bank currency swaps, which they were not listing on their balance sheet and counting as liabilities, and they were doing them anyway. And, basically interest-free loans that they could cancel and not even have to pay them back. But with this euro-dollar market, the banks, and this goes back to the Rothschild quote about, I don't care about the politicians as I have control of the money supply. The banks these investment banks figured out ways around the rules. Initially, it was European banks who were doing this, and American banks opened up subsidiaries offshore so they wouldn't have to deal with banking regulators. And so in the last couple decades, euro-dollar offshore U.S. dollar treasury market to borrow there has exploded in size. And hedge fund manager Jeffrey Snyder said, according to his research, and he's considered one of the experts at this, he said that between investment bank to investment bank and corporations borrowing from investment banks and sometimes not even listing this stuff on their balance sheet, there's now an additional $14 to $15 trillion in investment bank to investment bank currency swaps. So that's an additional amount of liquidity. And when you get to that size, Dave, you're basically your own separate either country or central bank when you get to that trillions of dollars in size, because there is nothing that big. There really, other than the Federal Reserve and a few other central banks, there's really nothing even close to that size. So this is the bankers have figured out a way to cheat the system. They actually, with the leverage ratios and saying the assets that they have, they've lied and said that their assets are quality. I believe Salomon Brothers, like 20 years ago, got in trouble. They were trying to drastically, at a treasury market, they were trying to drastically overpay for treasuries. And so they got investigated for this. Well, why at a treasury market are you willing to drastically overpay, outbid everyone else by a lot for the treasuries? And so they did digging, and they found out that Salomon Brothers had figured out a way to use those treasuries as collateral, leverage those things up by many, many times, and go and make crazy amounts of loans and bets and speculations all over the globe. And so basically the last couple decades, a lot of the banks have gotten into this junk.
I mean, from what I'm hearing, it sounds like this is like a black market central bank system. Where they're not, really, like it's like all underground. Like, oh, we're doing this, we're doing that, we're not reporting anything. I mean, that's what happens in the black market. It's all secretive and nobody knows about it, and nobody, really realizes what's going on.
Exactly. They don't carry it on their they don't carry currency swap. What Jeffrey Snyder said is that they don't carry these currency swaps on their balance sheet. So these are all off balance sheet. So when the banking regulators come, they say, okay, we have assets in treasuries, right? But the regulators don't understand that the treasuries are leveraged up manyfold and that they have all these off balance sheet liabilities that are way more than the assets the bank owns. And so I've said for years now that the European banks were in big, big trouble compared to American banks, that they were never recapitalized, and that the European Central Bank had been opening up trillions of dollars in currency swaps to basically buy up shares. There was a huge dip, I think, 2 years ago, year or two ago, in Deutsche Bank shares. And then all of a sudden, miraculously, the shares recovered. That was, in my opinion, probably the European Central Bank coming in and buying the shares so Deutsche Bank wouldn't collapse immediately. And so basically, I think they're aware now kind of that there is this huge problem, but they can't really fix it. And I don't know if they fully have – basically, if they came out and announced to people that, well, the banks have created another 14 or 15 trillion in liabilities. We're going to have to print the money and bail them out, or bail out the counterparties and the creditors and make them whole. There would probably be pitchforks if they actually announced that publicly. So I think that they've been trying to maybe print a trillion here, a trillion there, delay things out for a while. But European banks, I've used the analogy of economic landmines a lot, and I've said the European banking crisis is one of the biggest ones. And so far, with central bank to central bank currency swaps between the Federal Reserve and the European Central Bank, they've been able to delay this. But that market, that euro-dollar market, you have to watch where the money flows go. So I'm not an expert at this. Maybe you should have Jeffrey Snyder on to interview him and get him to explain this in easier to understand terms, because I've only spent about 5 hours researching this, and he's been studying. He specializes in this stuff. We mentioned a weaker dollar. We see the dollar is declining right now. With the dollar declining, how will this affect the precious metals market? Are we going to see
the precious metals move up, or can they still manipulate the precious metals market? What do you see happening here?
So they can manipulate precious metals for a little while longer. And when I speak with a lot of my listeners, a lot of them are frustrated. A lot of them have sold off their physical gold and silver. They've sold off their mining shares. A lot of them have started chasing the stock market higher and started speculating on cryptocurrencies, a lot of different ones I've never even heard of. But what most people don't understand is that this gold and silver paper price manipulation is a form of a price control. And so they can't manipulate gold back down to $1,000 an ounce and keep it there. They cannot manipulate silver back down to $10 an ounce and keep it there, especially for silver, because silver has so many industrial uses and it's needed for so many different uses, and the industrial end users. Basically, the silver market for that amount of physical delivery is pretty tight. And from even some anecdotal stories that some of the deliveries are late. But basically, they can keep it down for a while, but they're going to have to allow this James Turk or Bill Murphy managed retreat scenario. And this is the thing about price controls in economics. They maybe work for a little while. And so far with the manipulation, they've worked for 7 years. But they cannot keep the price down for forever, especially with silver, because there will be at some point shortages. Because the suppliers, especially for silver, because gold is not used in as many industrial purposes. And when it is, gold is recycled a lot. And there's also a lot of above ground gold, although a lot of that gold would not hit the market necessarily at $5,000 gold. So the gold stocks to flow argument, I respect that there's a lot of above ground gold. I just am in disagreement with a lot of the experts that point to that when they say that all this gold could flood the market, because a lot of that physical gold is used for jewelry. A lot of it's in central bank vaults. A lot of it's in, private vaults. And so it's not going to, in my opinion, it's not going to flood the market. So I do think in the next couple years, less than 3 years, maybe even less than 2, we're going to have new price floors. So the manipulation of gold and silver is a price control. And so they're going to have to allow gold back up to 1,400, 1,600 minimum, and that will be the new price floor. Otherwise, the gold supply from the miners, and that's important. Like I said, a lot of the stocks to flow people would disagree with me on this, but I think that the gold market is so tight that almost all that almost all that annual gold mining supply, the 2,500 tons or so, is basically already spoken for. Either private sector Chinese, private sector in India, and or central banks are buying up all that gold. Plus, China and Russia, which are large gold miners, they don't allow any of their own gold to leave the country. So there's not, out of that annual gold mining supply that's produced, there's not a lot of discretionary gold that's available for purchase. And so gold is going to go higher at some point. The funny thing is, a lot of the people who listen to these programs think that China has to do a gold-backed petro-yuan in order for the gold price to go higher. I don't think China wants a gold standard. Like I've laid out the case for why China is going to have to do a currency devaluation and or bailouts in the next couple years or worse. And so I agree with my buddy Louis Camersano at Small Gold. I know you interview him. We've discussed this a lot. I think actually a financial crisis in China would actually be bullish for gold. So I think, during the panic, maybe gold temporarily goes down, but then a lot of people who weren't paying any attention to gold would start to buy it again. So yeah, weaker dollar. If the dollar does stay weak, if there is no intervention in central banks, the one thing, Dave, about the currency markets that most people don't understand is the ability for these large treasury departments and central banks to go in there and manipulate. Now, if you're an emerging market country, it's harder unless you have an enormous trade reserve. But if you're a very large economy with a very large trade surplus, or you're connected to the Fed with some type of currency swap agreement, it's pretty easy for you to go in there and try and manipulate your exchange rate. So we may, we could see a scenario here, maybe where the dollar devalues too quickly and they go in there and intervene and, move it back up. There was a lot of people that thought the dollar was actually going to be strong last year, and it wasn't. So if the dollar had gotten strong in that scenario, remember about 15 or 20 years ago, there was a Plaza Accord agreement because they agreed to devalue the dollar because it was getting too strong. And if the dollar gets too strong, there's over $10 trillion in US dollar denominated debt in emerging markets, in foreign governments, in foreign central banks that can't really pay back those dollars. And they're betting that the dollar will get weaker. So the currency markets are very distorted. And just when you think that there's going to be a run on a currency, that the currency is going to collapse, the central banks come in and change the rules, the Treasury departments change the rules. This is the new normal, the world that we're living in now. So I'm perfectly relaxed having some cash, physical gold and silver. I own a couple different cryptocurrencies, Bitcoin. I'm not as bullish on Bitcoin as I used to be, because I think there really is some problems with Bitcoin that they're going to have to fix. Now, maybe the Lightning Network will fix it, but I would diversify and own a couple other cryptocurrencies. I wouldn't sell all my Bitcoin. And I think at this price, when Bitcoin is down with the sentiment, I think it's an interesting time to maybe buy a little bit more. But I wouldn't bet on Bitcoin as my only cryptocurrency at this point. I've actually been accumulating Litecoin now in addition, but I think there's other cryptocurrencies out there like Ethereum and stuff. So I think it's important for your listeners not to bet on any one thing in the environment we're in, with the politicians and central banks constantly manipulating or intervening in markets and constantly changing the rules. So own a few different cryptocurrencies, own some gold and silver. If there is manipulation in the gold and silver markets, the other point I wanted to make, and I think ultimately the real beneficiaries of this paper price manipulation, this bear market in gold and silver, has been the precious metal royalty and streaming companies. These guys have extraordinarily good balance sheet. There's 5 of them. I'll name them real quick. There's Franco-Nevada, Wheaton Precious Metals, Royal Gold, Osisko Gold Royalty, and Sandstorm Gold. Those are your 5. If you have the money to do so, I believe there's also an ETF that has all 5 that Frank Holmes just started. But if you can afford to do so and you're patient, just buy all 5, and there will be dividends. There will be large dividends in the future at some point. And if the precious metals are either capped at this price for a little while longer or temporarily manipulated lower, these companies, and they've done this for the last few years during the bear market, they will do even more deals for high quality long-term cash flow at outstanding margins. So these companies, those 5, more than the regular primary gold and silver miners, actually benefit from the manipulation, because they have low-cost cash flow, excellent margins. They can make money in a bear market. And that's why you've seen a lot of these companies just grow enormously in the bear market, whereas a lot of the regular primary gold and silver miners have struggled.
So for my last question here, the rest of this year, 2018, how do you see this playing out with, if there is a weaker dollar, how does it affect, pension? How does it affect the everyday person's life? How does it affect jobs? How does it affect everything if they're going to truly go down this path?
So I think there is going to be a lot of investment money coming back into the U.S., but I read an interesting article recently that was saying on a percentage basis, the amount is actually going more to shareholders with share buybacks and dividends than investments, but at least some money is going to higher wages and investment in research and development and creating jobs. So you can't perfectly, I hate central planning, but I want tax cuts. So obviously Trump and some of the others have been trying to, with tax rules and other loopholes, to get more money invested into the U.S. economy. That could potentially be the spark to get us even more inflation combined with a weaker dollar. So we could have a lot worse stagflation in our future going forward. Even if there's just some wage growth, that could be the additional velocity of money, and that fuels more and more inflation going forward. But I think if I had to summarize 2018, I think it's going to be the year that there is going to be more volatility in asset prices. This leveraged short volatility trade is just enormous. And we have a new Federal Reserve chairman taking over basically this week, since this was Janet Yellen's last meeting, Jerome J. Powell. And did you see the Fed transcripts that came out from 2012?
Yes.
Yeah. So Powell admitted in there that the Federal Reserve was shorting volatility, shorting the VIX, and that they were doing that to try to prevent a market crash. So they've been doing this for years. So I've said this for a while. I didn't have the proof until the Fed transcripts just came out. But this leveraged short volatility trade was initially started by central banks, and then all these other people, whether it's day traders, investment banks, even pension fund money, Dave, and you want to talk about pension fund money? Even pension fund money is involved in this really ridiculous, high risk for low reward leveraged short volatility trade that is now over $1.5 trillion in size globally with leverage. And more people pile into this trade. This is actually, besides long stock market, besides long FANG stocks, the Facebook, Amazon, Apple, Netflix, Google stocks, besides long regular stock market, long FANG stocks, the leveraged short volatility trade is the largest overcrowded trade on Wall Street. Like I said, there's pension fund money in this now with leverage trying to collect income. This is kind of reminds me of from the housing market from 2002 to 2006. China basically now with their credit bubble too is like the U.S. housing market from 2002 to 2006. We're in the boom phase of, there's all this money and credit that's been injected by global central banks. It's gone into a bunch of different assets and credit bubbles. None of these things that I've highlighted that are, by the way, there's over 40 of these economic landmines now that were not there in 2008. There's now over 40 of them. They're now over they're now over $1 trillion in size. And yet I think we're not quite ready to crash yet, but probably in the next 3 years. And, to wrap the interview up, I think, like I said, the central banks have distorted everything, combined with that Eurodollar market that sprung out of itself, that's unregulated, that basically these large banks have figured out a way around all the regulators and loopholes, and even around the central banks that are supposedly regulating them. And they've distorted things so much that we could have an enormous stock market boom continue for no fundamental reasons whatsoever, followed by an enormous bust.
Jason, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work and get in contact with you?
Sure. I have a YouTube channel that's that's almost at 20,000 YouTube subscribers. So hopefully a lot of your listeners who like this interview will subscribe to my channel and maybe sign up for my email list so I could update them there as 2 new business partners come into my company with investment money to help me build my educational technology business. And they can also go, like I said, to wallstreetformainstreet.com. That's WALLSTFORMAINST.com.
Fantastic. Thank